First, continuing liability until public notice. That means though the firm may have been dissolved, though partnership is dissolved, but there is continuing liability of the partners. The partners remain liable till when? Till the time they give public notice, because the firm has been dissolved, has to be announced to the public, has to be told to the public, because they were dealing with public. So now they have to tell the public that the firm has been dissolved, so they have to give a public notice. So even after dissolution, if they do not give public notice, they continue to remain liable till the time they give public notice. Once public notice is given, they are free of liabilities. Any acts done after public notice will not bind the firm. Okay. However, exception to this rule is estate of a deceased partner. If a partner has deceased, that is, he has died before the before dissolution, his estate won't be liable till dissolution or the public notice is given. I'll give you an example. Let's say one of the partners died on 1st March, and of the same year, on 1st May, the firm was dissolved, and the public notice was given on 1st July. So, the partners who are alive will be liable till 1st July, whereas the estate of the deceased partner, the partner who died, his property will be liable only till 1st March, the date on which the firm is dissolved. Because that partner has already died. On the contrary, far from being settling his accounts, his property was there in the firm, but he did not do any acts. He is not there to be liable. He did not do any acts. He cannot give public notice. So his estate, his property has been kept out of this rule that the partners are liable till the public notice is given. No. A deceased partner's estate is not liable till the public notice. It is only liable till the date of dissolution. Same is the case with insolvent partner. Again, insolvent partner is insolvent. He does not have any surplus assets, so his share won't be liable in any case. Same is the case with dormant partner. Now, public does not know dormant partner, so giving of public notice does not make any change in his life. Public notice is for announcing to the public, but in this case, public do not know that dormant partner is a partner in the firm. So, even if public notice is not given, his liability ceases. He is not liable. Second point, rights to enforce winding up. So on dissolution of partnership, any partner or his representative shall have the right against other partners. First, to have property of the firm applied in the payment of debts of the firm. That means whatever property the firm has, whatever assets the firm has, they have to be applied towards the loans of the firm, debts of the firm, the loans and debts that the firm has contracted. So, the partner has the right to apply the assets of the firm. Even if other partners are not agreeing, one of the partners can enforce this right on them and tell them, since we are dissolving the firm, whatever assets the firm has, let us first pay the outsiders' loans and debts. Okay. Second, to have the surplus distributed among the partners or their representatives according to their rights. Now, whatever is left after paying the outsiders, whatever assets or amount is left, they will pay themselves. They'll distribute it amongst themselves, and they'll distribute in the ratio or the rights that they had agreed in the profit sharing ratio or in the capital ratio or in whatever ratio they had agreed. Okay, next, authority of partners after dissolution. The authority of partner to bind the firm and other mutual rights and obligations continue, which are necessary to wind up the firm and to complete the unfinished transactions pending at the date of dissolution. Now, these are two authorities that the partners have. That is, to complete the unfinished business, whatever unfinished transactions are pending. It is quite possible that at the date of dissolution there may be some payments which they are yet to get, there may be some payments which the partners are yet to make. So these are unfinished transactions. There may be some goods which they have already purchased but have not paid for it. There may be some goods which they have already ordered but the goods have not yet come and they have not made the payment, or possibly they have made the payment in advance. So these are the unfinished transactions which need to be completed for dissolution, because on dissolution all the accounts need to be closed, everything needs to be settled. So they have the authority to complete the unfinished business, to complete the unfinished transactions. Plus, they can do all those activities necessary for dissolution. Here I am using the word winding up. Winding up is normally used, in synonymity with dissolution. They both are used synonymously. But dissolution is the first stage, winding up is the next stage, and it's the last stage. Winding up means closing down the books, the transactions, the business of the firm, doing activities which will close down the firm. Dissolution means it is something which breaks the relation between the partners. It dissolves the relation of partnership between the partners. After that, all the transactions which are pending, all those things which are necessary for dissolution are to be done. Okay, so when the order for dissolution comes, if the court orders or if the partners mutually decide to dissolve, then they'll have to do some steps to dissolve the firm. Steps like selling the assets of the firm, steps like paying the debts of the firm, steps like doing some expenses for selling the assets, selling some stock which is there on hand, which is unsold, so that also will have to be sold. So these are some steps which are required to be done for carrying out the winding up. After dissolution, winding up is to be done, and in winding up these things are carried out. Okay, so after dissolution partners have two authorities, that is to complete all the unfinished transactions, and second, to do all the transactions required for winding up. Next, settlement of partnership accounts. Partnership accounts are also to be settled, the books are to be closed. So if there are losses which have incurred, which are to be paid, then they will be paid first out of the profits, second out of the capital, and third by partners contributing from their personal assets in profit sharing ratio. So, let's assume that there is a balance sheet which, reads like this. There is capital of 100 and liabilities of 400. Again, here it reads like there are assets of 300 and P&L debit balance of 200. So the total is 500. Okay, so this is the balance sheet. So we can see that the balance sheet is tallied. The total is 500 on both sides. But if you carefully observe, the liabilities are 400 and the assets that I have are 300, because there are losses of 200. Now, this deficit has to be recovered from the profits. There might be some profits which were given to the partners in earlier years. So, that profits will have to be given by the partners back to the firm. So, once that is given, then this capital will be applied towards paying off liabilities. If that is also insufficient, then partners will bring in more capital, partners will bring in more cash, they'll inject some capital, and out of that, the losses and the liabilities will be paid. So the order of paying the losses or deficiencies is first out of profits, second out of capital, and finally, by bringing in more capital in the profit sharing ratio. The second point in this is assets of the firm plus contributions by the partners on account of deficiencies of the capital must be applied in the following order. Now, once the firm has cash, the partners have brought in the cash. Now, how does it need to be paid? So, who comes first? To whom should it be paid first? First, it should be paid to the outsiders. You should always pay it to the outsiders first, because it is quite possible that a partner would have given loan to the firm at the same time the bank has given loan to the firm. Who should be paid first? It is the bank who should be paid first, because it is the outsider. Partner is the insider, he is the owner, so it is a moral liability on him that he pays the outsiders first. Okay, so debts of outsiders are paid, then partners loans are paid. First was debts of outsiders, then partners loan, and then partners capital. Because once outsiders debts are paid, so outside liabilities are over. When partners debts or loans are paid, then all the liabilities are over. Now what remains is something which needs to be distributed towards the capital. Whatever capital balance is, give that balance to each of the partners. So next, partners capital is paid, and even after paying partners capital, if there is some balance left, it is to be shared in PSR, profit sharing ratio. So whatever cash, whatever assets the partnership has, first outsiders debts are paid, second partners liabilities are paid, then partners capital is settled, and after that whatever remains, whatever balance, if at all any balance is left, it is distributed in profit sharing ratio. So I'll give you an example again. If this is the balance sheet, and it's like this: A, B, loan by A, bank loan. So these, and creditors. So let's say A's capital is 50, B's capital is 60, this is 110. Loan by A is 15, bank loan is 20, and creditors are 5. So the total is 150. Okay. So we have fixed assets here, which is 80, and current assets here, which is 70. Total is 150. Now what the partnership will do is will sell off these two assets. So what the partners will do is, first step, they'll sell the fixed assets and get 80 rupees from it. Then they'll sell the current assets and then they'll get 70 from it. So now they have 150 rupees to pay off the liabilities. So whom will they pay first? They'll pay the outside liabilities first, and outside liabilities are these two. These are outside liabilities: bank loan and creditors. So out of 150, they'll pay the 25 rupees. Okay. So now they'll be left with 125 rupees. So first they'll pay the outside, then they'll pay the loan. So they'll be left with 110 rupees, and with those 110 rupees, they'll settle the capitals. Now, what happens is sometimes assets realize more. It is quite possible that the book value does not represent the market value. The asset in the books is at very lesser amount. It appears at a very lower amount because of depreciation, but in the market it might quite it might fetch a good amount. So instead of 150, the partners are able to realize 200. Okay, so the partners are able to realize 200. So out of the 200, they'll again first pay the outsiders loans, which is 25. So they'll be left with 175. Next they'll pay loan by A. So 175 minus 15 is 160. Then they'll pay the partner's capital, which is 110. So 160 minus 110. So they'll be left with 50 more. Okay. Now this 50 rupees is surplus. What do we do with this 50 rupees? With this 50 rupees, it will be distributed between A and B in the profit sharing ratio. Now let's say the profit sharing ratio of A and B is 2:3. So 20 will go to A and 30 will go to B. Okay. So this is how distribution of cash and the assets and contributions of the partners is done. Next point is personal profits earned after dissolution. It is important to understand that the firm getting dissolved and the firm getting wound up are two different things. Dissolution is only the end of relationship between the partners, but they continue to remain liable till the public notice is given, and also till the time winding up is not done. Till the time the winding up is not done, they continue to remain liable. Now, during this period, that is after dissolution, but before winding up, if a partner earns profit in his personal account, on his personal name, then such a profit has to be given to the firm. Such a profit has to be applied to the firm, and all the other partners will have a share in this profit, because it is said that the partners should first wind up the firm and then get on with their personal businesses. Because what will happen is, if they continue with their personal businesses, then possibly they might not be able to pay attention towards the winding up activities. So it is important that they complete the winding up activities and then do their personal businesses. Next, return of premium on partnerships premature dissolution. Sometimes before admitting partners, a premium is taken from them, goodwill is taken from them. You would have seen in partnership accounts, we calculate goodwill that is to be brought in by the new partner who's being admitted in the firm. So he brings in goodwill. Goodwill is nothing but the additional amount, the amount over and above his capital that he will pay. Okay, so this is called as the premium. Premium means amount over and above his capital. So let's say the partner brings in premium for 10 years. He thinks the firm will continue for 10 years and he brings in premium for 10 years. But let's say we have a premature dissolution. Premature dissolution means dissolution before time. Let's say the firm was to continue for 10 years, it was a fixed period, but we have dissolution, let's say, in 4 years. So it's a premature dissolution. Now he had brought in the amount for the full term of the partnership firm, but partnership firm has a premature dissolution. Then what is to be done? Then the partner paying the premium is entitled to return of premium as such part thereof as may be reasonable. This is important. So now he has the right to take, to get a return of his premium. Now, how much will be returned? That is a matter which has to be decided between them. It has to be reasonable. So it has to be decided between them as to what is reasonable, and if they agree on it, all is well. If they do not agree on it, this partner can go to the court and get his premium returned. So this word reasonable, it may differ from case to case basis. But however, regard being had to the terms of the agreement. When he came in, what were the terms? Was he told that he will be returned premium if the firm has premature dissolution? Was he told that full premium will be returned to him if the firm has premature dissolution? Was there a condition that 50% will be returned? Was there a condition that proportionate premium will be returned? So if there was a term which was agreed, then that term will be followed. If no term was agreed on this, there was, the partnership deed was silent, then a reasonable amount of premium will have to be returned to him. also considering the length of time during which he was a partner. For how much period he continued to be a partner. I'll give you an example. Let's say partner, was admitted by paying a premium of 1 lakh, which was for 10 years, and he is asking for a return of premium because the firm dissolved after 4 years. So now he was partner for 4 years, but the firm did not continue for the remaining 6 years, so he should get the amount of 6 years back. So 1 lakh divided by 10 into 6 will be returned to him, which is 60,000. So this factor may also be one of the deciding factors as to for how much length was he a partner. But this is, not the only factor which is to be seen. Okay. Except when the partnership is dissolved due to death of one of the partners. If partnership is dissolved because of death of one of the partners, then premium cannot be returned, mainly due to misconduct of the partner paying the premium. Now we know that partnership has to be dissolved because of misconduct of the partner, and he only is the partner because of whom the firm is being dissolved, because of whose misconduct the firm is being dissolved. Then he will not get any return of premium. And finally, pursuant to an agreement containing no provision of return of premium. If partnership deed said that even if we have a premature dissolution of the partnership firm, the premium will not be returned, then there will be no return of the premium. Last point, recession of partnership for fraudulent act. Recession means cancellation. Leads to following rights of agreed partners. Agreed partners means victim partners on whom the fraud has been conducted. So there is one partner who has done fraud, and there are the other victim partners, agreed partners. So if one partner has done fraud, this leads to following rights of victim partners, agreed partners. It is lien on surplus after payment of all debts to third parties for any capital contribution made by them. So the other parties can have a lien on his, he has a right to get his capital contribution back on dissolution. So the other parties, the other partners will have a lien on this partner's capital contribution. They have a right that till the time the fraud is corrected, whatever fraud he is done, if he does not mend it, if he does not repay the amount that he had cheated with the firm, they can hold his capital contribution back. So they have a right of lien over the surplus which needs to be distributed for capital contribution. Next, to rank as creditors of the firm in respect of any payment made by them towards the debt of firm. Now the partners will rank as creditors, as outsiders. They'll be treated as outsiders of the firm. The meaning of this is they'll have a higher right. We have already discussed that first outsiders' liabilities are settled. So now they will be considered as outsiders, and this partner will remain insider who has done fraud. So outsiders will be paid first. So these partners will be paid first, and then they can have a lien over his share. And finally, indemnity from guilty partners against all debts and liabilities of the firm. The guilty partner will have to give indemnity. Indemnity means making the loss good. So whatever loss has happened to the partnership firm, the other partners can get the indemnity from the guilty partners. Guilty partner means partners who have committed fraud. They'll have to pay to the firm for all the losses, okay, for all the debts and liabilities. So this is what happens when dissolution of the firm takes place. These are the consequences of dissolution of a firm.